Imagine this, you bought a pre-construction condo in 2019, you stretched to make the deposit, watched prices soar, and thought you'd made the smartest financial move of your life. Fast forward to 2025 and that same condo you were counting on to build equity is now worth less than what you paid for it. You can't sell it, you can't rent it for enough to cover your mortgage, and buying another one, forget about it. Across Ontario, thousands of condo investors and owners are facing this exact nightmare. The market has frozen. Welcome to Ontario's condo crisis, a perfect storm of oversupply, high interest rates, and buyer fatigue that's reshaping one of the hottest real estate segments in the country. Let's rewind. For nearly a decade, condos were the backbone of the Canadian dream. The entry point for first-time buyers, the cash cow for investors, developers couldn't build fast enough. Low interest rate, foreign capital, and record immigration fueled demand. Every tower that went up sold out before it even hit MLS. But like every boom, it eventually hits a wall. And that wall was the Bank of Canada's fastest rate hike cycle in history. Suddenly, the math didn't work anymore. Investors who were banking on low interest rates and rising rents are now facing negative cash flow and in some cases losing hundreds and even thousands of dollars every single month. Developers, they're sitting on unsold inventory. Buyers who bought pre-construction might not even be able to close because their financing has evaporated. And for renters, the irony is brutal. After years of sky-high rents, they're finally easing, but not enough to offset the economic pain everywhere else. This isn't just a small correction, it's a turning point. One that's testing whether Ontario's condo boom was ever truly sustainable, or if it was just a house of cards built on cheap money and speculation. In this video, we're going to break down what's really happening, what caused this crisis, who's at most risk, and what comes next for condo owners, investors, and anyone still dreaming of buying. Let's start with the numbers because the data doesn't lie. According to the Toronto Regional and Real Estate Board data, condo listings have nearly doubled from a year ago, while sales have dropped by more than 40%. That's a huge imbalance. And when supply rises faster than demand, prices fall. Simple economics. Average resale prices for condos in Toronto have dropped drastically from where they were in their peak. But in some pre-construction buildings, the losses are much worse. Down 20, even 40% in some areas. For many investors, that drop erases every dollar of equity that they thought that they had built. But the real pain point is carrying costs. Let's take a practical example. Someone bought a 500 square foot downtown condo for $650,000 with 20% down. That's a $525,000 mortgage. In 2021, their mortgage payment at 1.9% interest was about $2,200. Today, that same mortgage at 5% is over $3,300 a month. Add $800 in condo fees and $300 in taxes, and you're almost $4,400 a month. But the average rent for that same unit may be $2,800, $2,900 if you're lucky. That's a $1,500 loss every single month. For years, investors could stomach small losses because prices were rising so fast and it didn't matter. And now values are falling, and those investors, they're trapped. They can't refinance because their property is worth less. They can't sell without taking a loss, and they can't rent for enough to cover their costs. This is the core of Ontario's condo crisis, a liquidity trap created by rising rates, over-leverage, and overconfidence. But it's not just about the individual investor. The ripple effects are huge. Developers are being hit hard. Dozens of projects across Ontario are being delayed or canceled outright. Construction financing is drying up. Some builders are offering massive incentives just to move inventory. Things like free parking, zero maintenance fees for 2 years, even furniture packages. And the new reality, developers are cutting back, which could mean a future housing shortage just a few years down the road. But for now, the short-term pain is real. Thousands of pre-construction buyers who bought at the peak are being told that they need hundreds of thousands of dollars more to close on that exact same unit. Why? Because their mortgage approval from 2021 expired. And when lenders reassess at today's rates, their qualifying power drops by 25 to 30%. And we haven't even touched on that the appraisals are coming in lower. With buyers being infirm, they need to make up that difference because they're under contract. So if you purchased a condo for $850,000 and your approval is for 80% of that, and now that the appraised value is coming in at $600,000 or $650,000, the lender will only lend on 80% of today's appraised value, meaning that you need to fork out hundreds of thousands of dollars just to qualify for that same property that you thought you had years ago. And that creates a whole other crisis in itself. Some are just walking away. Others are trying to assign their unit, selling before closing. But there's no market for those assignments right now. And here's the catch. Many of those investors were counting on appreciation to fund their retirement and pay off debt. Now they're being forced to liquidate under pressure. For renters, it's a different story, but not necessarily a better one. Rents have softened slightly, but affordability hasn't improved much. The average one bedroom in Toronto still costs over $2,500 a month. For someone earning dollars a year, that's half of their take-home pay. So who's left to buy? That's the question haunting the condo market. With mortgage rates still high, the pressure of the stress test, and a population facing job losses and higher living costs, the buyer pool has dried up. Even first-time home buyers who want to take advantage of lower prices can't qualify. They're either priced out by interest rates or scared off by the market's uncertainty. So we're stuck. Too much supply, not enough buyers, and investors desperate to exit, but with nowhere to go. The longer this stalemate continues, the greater the long-term risk becomes. And why? Because distress doesn't just stay contained, it spreads. We're already seeing early warning signs. Rising delinquency on investor-owned condos, more power of sale listings, and landlords cutting rent just to attract tenants. And here's where it gets tricky. If condo prices fall far enough, it could start dragging down the broader real estate market. Remember, condos were the entry point for many homeowners. If they can't sell their condo, they can't move up to a townhome or detached home. That freezes the entire ladder. It's a chain reaction, and right now, Ontario's housing market is showing cracks at every level. But with every crisis, a crisis also creates opportunity. Because in every market downturn, there are buyers who act while others freeze. So the real question isn't just how bad will this get? It's who will position themselves for the rebound. So where do we go from here? Because as bad as this looks, this isn't just the end of the story. Real estate markets are a cycle. They expand, they overheat, and they correct. And then they reset. And right now, Ontario's condo market is going through a reset phase. The first thing we need to recognize is that this correction was inevitable. For years, condos were treated like speculative stocks. People were buying with the intention to flip, not live. Now fundamentals are taking over again. And that's not necessarily bad. It's a return to sanity. And for serious investors and home buyers, this could be the best opportunity in decades to get in smart. Here's what I mean. Number one, for the current condo owner, if you're holding negative cash flow, the worst thing you can do is panic sell. Take a step back and look at the numbers. Can you refinance? Can you consolidate debt to reduce monthly strain? Sometimes rolling high interest loans into your mortgage can free up thousands per month and buy you time until the market stabilizes. Number two, for investors, this is the moment to think long-term, not emotional. Real wealth in real estate isn't made by buying at the top. It's made during a down cycle. Focus on cash flow and fundamentals. Look for buildings with low maintenance costs, strong reserve funds, and locations near future infrastructure projects. Don't chase appreciation, chase sustainability. Number three, for buyers and renters dreaming of ownership, you finally have breathing room. With supply rising and competition easing, you can negotiate again. You can get conditions back in your offer. You can make smart, informed choices, not emotional ones. The key is to prepare now. Get pre-approved, understand your borrowing power, and track the market, not the headlines. Because when rates begin to fall, and they will eventually, demand will surge again. Those who prepare during quiet phases are the ones who win when the market turns. For everyone watching, whether you own, rent, or invest, this crisis is a reminder. Real estate isn't just about prices, it's about positioning. It's not about timing the market, it's about time in the market. If you're feeling stuck or unsure where to start, that's exactly why I do what I do. My job is to help you understand your options, find the right strategy, and make confident decisions in any market. Because even in a crisis, there's always opportunity for those who are informed and proactive. If you'd like to review your mortgage, explore refinancing options, or understand what this market shift means for you, you can book a free call with me at meetjustin.ca or in the link in the description below. I'm Justin Chaussee. Thanks for watching. And hey, if you found this video helpful, please hit the like and subscribe button so that we can continue to make more videos like this for people like you. Thanks for watching, and I'll see you in the next video.